Now, before we get into some of these really interesting charts on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis, I want to start off by going over some of the basic principles of technical analysis. I want you to have these in your head to really understand what it is that we do here on the show and better help you understand what it is that we will be going over. A couple things that I want to call out here is number 2, and that is price action, volume, and volatility are the key indicators. These are the most important aspects. Most indicators are derived from actually price action and volume. And this is one of the things that we pay close attention to while we're doing our analysis. And I'm adding volatility in here too, because this is also quite an important indicator to be watching. Now, something that I really frequently talk about of one of the other basic principles of technical analysis is markets alternate between range contraction and range expansion. When things contract, things eventually expand. When things expand, things typically contract. And then the last one over here that I will call out is that technical analysis cannot predict price moves, but it is a tool to help you forecast price trends. Now, understand that when you forecast, you can't control where price will eventually go, but there are 4 things that you can control while you're trading and analyzing the markets. And that is what to buy, how much to buy, when to buy it, and when to sell it. Notice here, it doesn't say and control how high the price goes or how low a price goes if you're shorting it and so forth. Focus on what you can control to become a better trader. So now that that's out of the way, I want to hop into some of the interesting charts today, and then we'll get into a little bit more detail and talk about some events that are around the corner. We'll start off here looking at the market dashboard, and you can see today we saw a rotation into energy, financials, even materials over here, while technology was the one that got hit. But overall, the markets fared rather well. It was the Nasdaq, right? Heavy tech related was down 0.5%. And then the Nasdaq 100, which is even more tech focused, was down almost 1%. But overall, the market fared rather well. Now, I do find it interesting that financials is up here as we're seeing this kind of rotation into there, because financials have been on a monster tear. And you can even see here, looking at the bullish percent index, 88.89% of the stocks within the XLF are on buy signals. And typically when we get into these very high readings, we actually go through periods of consolidation like here, and then right here was the last time, and then we went through that period of consolidation. And also the RSI is moving up there too. So very interesting price action in a very short period of time. That's very rare to happen. Now, if we dig a little bit deeper, instead of just looking at the 11 sectors that make up the S&P 500, let's take a look at some of the factor exposure and the various sectors as well on this specific chart. If you look to the left of the screen, what actually was one of the top performing on this chart? Well, it was actually the VIX. So volatility of volatility. And that I find to be interesting as we're coming into some key reports here, because is that just telling us that traders are now reaching for protection as we head into PPI tomorrow, an hour before open? And then we also have Michigan consumer sentiment on Friday. And more importantly, too, we also have the triple witching taking place, one of the largest option expirations, right? This only happens a few times a year. So, and then you look, right, so there's energy, and then right next to that is also skew, which can indicate that too as well. And then towards the bottom of the chart, this is what I found interesting. Volatility was down today, so VIX was down, VVIX was up, and then tech was down there too as well. So an interesting market. So I want to hop into some of these charts that I thought were very interesting from the weekly perspective. And I want to start off here looking at the VIX. And what we're doing here is we're kind of building on the whole principle that markets alternate between range contraction and range expansion. And when you look here, this is the VIX, the volatility index on the weekly time frame. Now, the week's not over yet, so we'll see where this closes. But I apply a Bollinger Band. Bollinger Bands are also known like our volatility bands, right? And you can measure the width of them when the width closes in, when it gets, the top end goes down and the bottom end goes up and they get tighter. That is volatility contracting within whatever asset it is. And you could apply these also to volatility as well, right? It's just a mathematical equation. And what you can do is use the indicator called BB width, which is just measuring the difference between the upper band and the lower band of the Bollinger Bands. So, and then it draws it out on this specific chart. And I wanted to call this out because I noticed when I was pulling this up that the top end has been sinking, the top end band has been sinking, the lower band has been rising, driving the Bollinger Band width to be incredibly tight. Down right now it's at 22.85. And I was wondering, I was like, okay, well, when's the last time it's been this tight? You look back to the left of the charts, and we haven't actually had the Bollinger Bands this tight since 2007. I just found that to be incredibly interesting here. So we'll see. Like I said, I don't know if the week's going to be closing here, but I am noticing that they are closing in quite rapidly. And I wanted to call that out because of the fact if we start to get an expansion in volatility upticks, right? I'm not calling out for the great financial crisis here, but you can see potential pops. So that's just VIX for S&P 500 volatility. But also look at VXN, which is Nasdaq volatility. This is a little bit different story. This volatility band is coming in, this one's coming up, and we're seeing a very tight contraction taking place within the volatility of the Nasdaq 100. But look to the left of the chart. When's the last time we've been here? Well, the last time we were here was actually just in August, September-ish area of 2023. And then what happened when we started to expand? Well, you can see volatility popped up, came back in, and then we started to actually expand more so there later on. So volatility did pick up a little bit there on VXN. Now, if you dive back even further, so when's the last time it was like, is this frequent? Does it happen, often? Well, then I pulled up also a long-term chart dating back to 2007 or 2006. And it hasn't been here since 2007 as well, despite seeing this one right here. So that's on the Nasdaq 100 as the volatility is here contracting. And then Russell volatility is RVX. Yes, you can track volatility of multiple products, including Apple, including Goldman Sachs, including Google, including Amazon. You can check that they actually have volatility products for those that you can measure and map out. And then I looked at RVX and Russell volatility here. It's getting a 24.73 reading. So I drew a little line here to the left hand of the screen. And this actually hasn't happened since 2018. So volatility came in, it got really tight, and then we saw an expansion in volatility shortly after. But remember, we were down here for multiple weeks. It could be a month or so. So I'm not saying that there's this anything crazy is going to happen or how it's going to resolve. But I do find it interesting that volatility is in the contractionary phase here. Something to just take note of, because if it expands, we won't get caught off guard here. Now, this was in 2018, and there's actually an interesting note today from Goldman Sachs, so I'm going to read that to you. This popped up on the Gamma the Lab news feed, and Goldman had stated a couple of things. So I'll just read it off. So equities are telling us that the U.S. economy can handle structurally higher interest rates, which interest rates are obviously higher in this current moment, right? With the current market implied U.S. equilibrium rate at 3.45. Essentially, what this is the rate at which the economy can plot along nicely with the right mix of growth and inflation versus the Fed's current ratio. Now, they had mentioned that there is also chatter from some Fed officials, whatever that means, that the neutral rate may have risen and might remain higher for longer. This is important because if the Fed decides to move the long run dots higher next week, this could have implications for risk assets as it did back in 2018 when Powell stated, "We are far from neutral." So I do find it interesting that implied volatility is coming off. We haven't seen since Russell volatility since 2018. And we're starting now to talk about this stuff, which, is more of a narrative than anything. But what happened in 2018 was a very similar same situation as far as volatility bands contracting or Bollinger Bands contracting. And now if Powell comes in pretty hawkish, well, this could potentially mean something. Now, they also had mentioned that underlyingly we are in a bull market, which is true. Price action is a key indicator and it is up, right? So, but with Powell set to hawk next week and vol is so cheap, so they're seeing vol downside before the next leg up looks attractive. Now, we'll see what the Fed says because their main goal is keeping inflation down, getting it down to that 2%, right? Or they're going to hold rates higher for longer until they start to see that come in. But actually, we're seeing hotter than expected inflation numbers. And now we're getting things like copper to start to break out. And this could very well lead inflation higher, right? This is an economic metal here, a very important one to pay attention to. But it's not just that. You can look at energy or oil, and oil was up on the day too, and it looks like it's still contracting within this area. And if oil starts taking off, this could be telling us and signaling us that inflation could be here for a longer period of time, and they don't quite have a wrap on it yet. So overall, I'm pointing this stuff out because once again, it's not to predict what can potentially happen, but it could potentially forecast larger moves in volatility in somewhat the near future. Now, what else could be leading these volatility spikes? We talked about we have a couple macro events coming up. We always are going to have these macro events coming up. So what I like to do is look at what the options market is pricing in as far as an expected move. And going into tomorrow, we have a daily expected move of 29.79. That's the upper level or the lower level, right? It's plus or minus, and these are the 2 sigma levels. That's for the SPX. You can ignore the ESH contracts, but I do have them there. I will be converting these to the June contracts once we start to get those daily expirations. And then I have the SPY and the Q here too. If you like these levels, I sometimes share them here, but I also share them as one of the many benefits for the swing trading community, which is only $9 a month. I do all kinds of things there. I include the entire TradyTix Discord bot suite, which includes the query channel where you can type in various different commands to get all kinds of information on individual stocks and stuff, and very cool little charts and goodies there. And then there's a scalp bot, bullseye bot. That's all from TradyTix. I mean, TradyTix is not cheap software, and this is included in the $9. Okay, then we include the zones, which is a cool bridge band indicator, but I built it out into a zone document that shows where prices from a fractal perspective on a very cool sheet. I'll have to share it another day. Monthly expected moves, weekly expected moves, daily expected moves. I give my watch list, and my watch list now includes my tight list, which is all the stocks that are contracting within my tight list. I put out some of the trade ideas. This is not an alert service by any means. And then you also get access to the community as well. Yes, that's $9. It's pretty crazy, right? It's one trip to Starbucks, but that's $9 for an entire month. Let's get into the S&P 500 on the SPY 15-minute time frame, because the volatility stuff, that's pretty cool, but we got to get a little bit more tactical here too. We've been saying that this is going to be more difficult environment to navigate, and as you can see, this has been pretty difficult, right? It's been putting in higher highs and higher lows for the most part, right? Boom, 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 boom. But we've been seeing some pretty strong hits to the downside, creating this volatility. Now, the 5-day moving average, it's still inclining, right? Even today, we saw this weird 2-minute volatile spike towards the end of the very just weird. But overall, the trend is up. We're above the week to date anchored VWAP. We're above the month to date anchored VWAP. And we're above the rising 5-day moving average. And we still haven't tagged actually one of these weekly expected moves yet. I still think that these are in striking distance here, given the gamma levels that we'll go over here in a moment until option expiration ends. So as it stands right now, the trend still, the bulls are intact. Until that changes, what you'd want to see is a lower low, right? Lower high and a lower low. And then you'd want the 5-day moving average to start to turn over. And that can happen quickly. But remember, if we get under it and it's still rising, could be bearish, but it's with caution. And the caution, I'll show you once again, this is why it's cautionary. Boom, snap, boom, snap, boom, snap right back, right? It happens less if this was actually declining. Then you can be bullish with caution if this was the 5-day moving average and then price started getting above it until it starts turning back around, and then you start to play with the trend, the short-term trend in your favor. If we take a look at the SPX, today was a nothing burger day. If you were watching our Twitch live stream, we kind of called that out in the early trading session, that it looked as if it was going to be a chop day. Nothing too crazy. We looked at some important stuff, and that's what we came to the conclusion of. And it was basically on the SPX, just an inside trading day, right? Expansion, boom, leads to contraction. It's in bullish context. So if we start breaking the high of this, start looking for the upper daily expected move for the SPX to get tagged. We already noted what that level was, 41.95. We can potentially reach further out to that 5,200 because that is an important level there too. But I would be paying close attention to this range of risk tomorrow going into that PPI data report. If we gap up into this level, be cautious. Because, why? Because it's going to be hard to escape this specific gamma exposure level, right? This 5,200, that is the massive call wall. And we'll come back to that here momentarily. But what I wanted to also point out here, as the market's been driving higher, we're in positive gamma territory, right? That's where dealers look to buy the dip, sell the rip. You can see that here on this chart. Here's the gamma flip line as it stands. It's now 51.30. We'll see where that's at tomorrow. I'm going to try to go live tomorrow. I'm not 100% sure if I can, but it's going to probably be in a tight range until we get this gamma roll off. Now, I also wanted to note, as the price actions have been moving up, we've been seeing a divergence in the RSI. Wow, that's so awesome. Right? A divergence in the RSI. So the price action is going higher in the SPX, but you can see the multiple series of lower highs in the RSI indicating that price is going stronger, but the internals here are weakening. And I have looked back on a chart, but I've never quite seen something like this. And now I know people that map out trend lines on the RSI for when trend lines break. And that's totally fine. But I have never seen a compression pattern quite like this on the SPX. And you can just see a big expansionary move even here. And even this indicator itself is contracting and coiling up, and it's reaching around to the apex of this. And that, to me, I find to be incredibly interesting. So perhaps this can even expand, where we're going to get a lot stronger of a move here in the near future as well for something like the S&P 500. It's not the only index that has a negative divergence. The Dow Jones Industrial Average has a negative divergence as we're sitting around at these all-time highs. Nasdaq 100 has that negative divergence, and that's not just in the RSI, it's also in the MACD for both those products as well. I'll quickly show you the 15-minute time frame on the Qs, because I showed you on the SPY, right? And that's actually pretty bullish. Why is this bullish? Even though the Qs were down, the Nasdaq got hit, it's because energy and financials really are helping out here. So when you look at the Qs, it tells a little bit different of a story. Price action's been going sideways. Back to the narrative, this environment could get a little bit more difficult. Well, this is showing you that difficulty level. And the 5-day moving average is starting to flatten out at this current moment. It was down 0.77% today. And if we hold under this 5-day moving average and it starts to curl over, it could potentially start breaking some of these lows. And if that's the case, this could be an area to look for down here, the gap fill, which happened to be the gap up from, I believe it was, NVIDIA earnings. So just notice, after the gap up on NVIDIA that day, right, we're back to where we were, right? We're just right here at this volume point of control. So if we start breaking back down, just be careful, right? The trend is neutral. So under it, that's bearish, and it's neutral. So it's kind of like bearish with caution, but it's neutral, right? But then you look at like the daily, and it's been kind of putting in higher highs, higher lows. So it's a cautionary tale here for the larger mega cap names, unless if we start breaking back above and we start changing the tune of this high, this lower high, and this lower high. All right, we have a low, a higher low, a higher low, and a higher low. So price action here is also compressing, right? It's coiling up. That's not the only one though. IWM is a similar story here. IWM is looking pretty decent from a daily perspective, but look at the 5-day moving average, right? We've been going sideways here too, chopping around, right? We get a little explosive move, and then we came back in, and then the 5-day moving average is neutral here as well. So, to be a little bit more confident, I would say this level looks to be pretty incredibly important, incredibly important, 206.50, and I'll draw it across the screen, because what you see here is it acted as resistance, held as support, and then we cracked through it. The price action during the cash session couldn't get through it. It took NVIDIA earnings basically, I don't know if that was NVIDIA earnings or not, my bad. It took this gap up to get through it, and then it held as support, and we pressed higher. And then we broke through it, and now we're holding it once again as a level of resistance. So 206.50, if we can get above there and hold it, and then maybe have a stop under this swing low or this swing low, depending on how you want to trade it, and the 5-day moving average starts to turn back up again, that opens the door to swing back up to 210 and potentially even higher in something like the IWM. Now, IWM was up 0.39% today because, well, there was actually more advancing stocks in the stock market in the S&P 500 than there was actually much more advancing despite seeing the hard price action. It was just the mega cap names that was really kind of dragging this market down. But let's take a look at the net gamma now. The 5,200 level, the reason why I was saying is so important is because just look at the size of this call wall. So to escape this level to the upside is going to be very difficult if traders don't reach out here. And now coming into the end of the week, which is Friday, the gamma expiring is about half. So this is a large expiration, which means if we come into 5,200, it can hold as a pin where we currently are. So back to this level where we are, right? 5190 has been holding as an interesting level on this SPX chart. It was even a good 0-date level earlier in today's trading session, and it's been breaking from it. It gets up to it, breaks from it, got up to it, broke from it, we had a little break from it there, break from it there, and then we had a break from it again. So it's going to be kind of hard to, I'd say between 5150 to 5200, right? We have Thursday and Friday, and until Friday starts rolling that off, right? Maybe perhaps then it'll open the door for traders to reach out further, maybe push the market higher to move more freely, or potentially break down. Till then, though, the S&P 500 is still in positive gamma territory, so that's positive, right? That's where dealers look to buy the dip, sell the rip, and we're above a rising 5-day moving average. So as I'm going through this, I want you to make sure that you're seeing some of the cracks, some of the larger market cap names like the Qs. It's below the 5-day moving average. It's still flat. We're going into some key macro data reports. Volatility is contracting. We know that price contracts and then it expands. This is all going back to the narrative of that this is going to be a much more difficult environment. So we got to continue to just be very agile, be careful. And I know it's crazy to think that, no, but we're at all-time highs, everything's fine. But even Goldman Sachs, right? And they're wrong all the time. They were even wrong on their report. But what some of the people say actually makes quite a bit of sense. For example, that guy said, it is clearly a bull market, but it would be not, what did he say exactly? I'll just go back to the little quote there. Undeniably, we're in a bull market, but with Powell set to hot next week and volatility so cheap, downside before the next leg up does look attractive. It doesn't mean it's going to happen, but it does look attractive. And that's the truth. I mean, I'm looking at it here too. Downside move could set up for a nice another rally. Now, I want to hop into a couple other indicator charts that I find interesting, and I haven't showed this for a while, but the Nasdaq summation index, right? The Nasdaq has been moving higher. The last crossover that we had was this bullish crossover here on the Nasdaq summation index, and the SAR was below it, but we're starting to turn back around here. So is it going to identify a potential change in trend here? Notice here how this identified a potential change in trend to the downside, but the market, it kind of went sideways and then continued to press higher and higher up until this point. Then it flipped over. So this was kind of a false signal. So is it going to identify a potential change in trend? Now, what I do find is this was pressing higher. There's still a quite big divergence here from that high to this high and this high to that high. And then you look at the Nasdaq McClellan oscillator, and this has also been diverging as prices kind of been moving higher and higher too. Even in the short term where you have these, a high, lower high as price actually moves higher. And we even went down into negative territory on the NAMO today as well. You can even potentially look at this and say, even this is, compressing right here, how it expanded, boom, and it's tightening up in this area as well. The NYSE summation index, so for the New York Stock Exchange, this one is still pretty bullish and trending up, and this market's been kind of just, it's been quite crazy, just grinding higher and higher, okay? But there's also been a pretty big divergence here too as well on the Nasdaq McClellan oscillator, the traditional calculation. And I think this is still worth paying attention to, because when volatility, right, it contracts, you have smaller up days, right? And it grinds higher. But when it expands, you can have like one big down day, wipe out like 6 or 7 days prior, or maybe 2 down days that wipes out a little bit more. And then people are freaking out. But then it ends up, being a potential oversold condition where you can then have that opportunity to go long, right? When you buy back into the strength. Another indicator that I find to be interesting is one known as the old fool indicator. And this is taking the NASDAQ composite and dividing it into the options, the CBO options total put to call ratio. So that's what the purple line is. But to smooth it out, you can apply a couple of EMAs, 21 and 50. And what you'll notice here is when the green line, which is the 21, crosses beneath the blue line, it can mark a sell signal. These are lagging indicators, obviously, but sometimes the trend holds for quite some time. And you can see we crossed over here in August and it went through that bear market right till October, right? We went down further, but we rallied right back, and then we went down, and then we went down. And during that entire time, the 21 was trending below the 50. And then we crossed over here, right? It didn't catch this portion, but it did cross over here November 13th. And then since that point on this gap up, the market has been trading higher and higher and higher and higher, right? And it's been in this bullish context. I am starting to notice that it's starting to curl itself over a little bit, which may indicate a potential crossover here in the near future, but it just has not happened in this current moment. And I'll notify you when it does. Now, prior to this, I do have a chart that shows like a lot more of them, and it's fairly accurate, but this one happened like around this time, and it caught this move too as well, the buy signal. And then I'll end off here. if the market is setting up for volatility to contract and it expands, I wanted to go back to this chart. I don't know if I shared this on the last video, but I definitely shared it on my Discord because I posted a video there instead of posting one on YouTube yesterday. And you'll notice back in 2007, this line shot up. What is this line? This line is actually looking at the relative performance between consumer staples and the S&P 500. Now, consumer staples got hit too, but you can see this line, they outperformed it, meaning that they went down less. And you'll see that there was a positive divergence in the rate of change there. And then we saw that move. And then more recently here, like in 2020, going into 2020, we saw that we had a lower low on this reading, but we had a higher move on the rate of change. But then I found even more interesting, 2021 into 2022, a positive divergence in the rate of change, a huge positive divergence in the RSI there too as well. And into 2022, we saw the outperformance in XLP, okay? And then it turned when we started to see a negative divergence in the RSI and a negative divergence actually in the rate of change. Why am I bringing this up now? Because we've been seeing a positive divergence forming in the RSI and in this rate of change. So this has been getting beaten up. So is this telling us an early indication that we may get a little pop where we see in the near future consumer staples, so more of a safety trade is what I'm trying to get at, outperform the S&P 500. Now, that does not mean consumer staples are going to go higher necessarily. Remember, they can go down, but if the S&P 500 goes down further and faster, this line would go up, right? So that's what that means. So as volatility is contracting, as we're starting to see signs like this, as the market's getting a little bit more difficult to navigate, as we're starting to see these negative divergences build, these are things that over the course of time are going to have to resolve itself. How it resolves itself, I don't quite know, because all I can do here is forecast. I can't quite predict. So the trend is your friend. Until it ends, be careful, be safe out there. That's all I got for you on today's episode.